everyone. I'm Neil Gilfedder, Chief Investment Officer at Edelman Financial Engines. I'm talking to you after markets have closed on Friday, April the 11th, and it's been another kind of wild week in the markets. The big news this week was on Wednesday when President Trump suspended temporarily the tariffs that he had announced the previous week. As well as suspending most of them, though, he increased the tariff on Chinese goods. And so what you're seeing is what's called the effective rate, the effective tariff rate in the economy is roughly the same as it was a week ago. It's more focused on China, one of our biggest trading partners, than it was on some smaller trading partners a week before. But markets really reacted. I'm joined by Katie Klingon-Smith, who's our chief investment strategist. Katie, what was the market's reaction to all of this?
It sure has been a crazy week or two. Markets were euphoric at the stay of implementation of the tariffs. But what's most interesting is that, equity markets experienced a big rally on Wednesday. But Thursday came around and suddenly they lost, close to half of what they had gained, depending on what you look at. Just the following day, they closed up on the week, but really a lot of up and down. I think what you just said, Neil, about uncertainty is really important. Yes, some of the tariffs that were announced are being deferred, but also, yes, tariffs are way up on an effective basis. And we don't know where they're going to land, either with China or with the many other countries that were proposed to receive a reciprocal bilateral tariff by the United States. So equity markets responded to all of the different pieces of information, and at least specifically to tariffs, I think that Wednesday euphoria was pretty quickly reversed by a reminder that this uncertainty is going to remain with us, and the potential downside of high levels of tariffs, even if it's focused on a couple of countries, that's going to be really tough for the real economy.
Yeah, I mean, it's important to remember that tariffs, even at the 10% level, are a lot higher than they were at the beginning of the year. 10% is lower than 25%, but it's still much higher than closer to zero than it was at the beginning of the year. Did anything stand out in equity markets, any particular types of equities?
Well, what's interesting to note is that there's been a general feeling against the US, and a bunch of international markets did better than the US markets did. We're still seeing European markets much better off year to date. We did see a bit of, over the last week or two, some of the pain that the US felt is certainly being felt by other countries as well, but very, very different activity. And so I think it's a time when it's hard to know exactly what's driving individual, sectors and countries. But because of that, it's important to have that diversification because not everything is moving in lockstep.
Right. Yeah, that's true. There was other economic news. So economic news that actually would have been fairly big were tariffs not the main story. What else is going on, Katie?
Yeah, that's right. That's right. So inflation is really what's going on elsewhere. We always get economic news, inflation included, that's real news, that's been measures of what has happened. And on Thursday, we got the CPI. So just the regular inflation read. And it came in quite tame. I mean, maybe a little higher than what we like it, what the Fed likes it, but quite in line with expectations. However, today on Friday, we got the University of Michigan Inflation Expectations Survey, highest in 44 years at 6.7% expectations for inflation a year out. Doesn't mean we're at these levels, but it sure shows that people are worried about them. So it gets us to really wondering what the Fed will and can do if there's some pressure to growth and some pressure to inflation. So actually,
Yeah,
on that note,
in the same survey, you had consumer confidence lower as well. So, which is a difficult combination of expectations.
indeed, and certainly goes to worry about economic activity. So no fun for us. Also no fun for the Fed, who is focused on what's going on in interest rate markets and treasuries. Before we close, Neil, there's been a real focus on treasuries the last couple of days. What's going on there?
Yeah, so if we look at the week that President Trump introduced the tariffs, or announced them rather, what you saw there was a sort of classic response, right? So something that's viewed as potentially negative in terms of the economy sends stocks down and bonds go up because people tend to put their money, money flows into safer assets. But this week, what we saw when the reverse happened, when the tariffs were at least held off for 90 days was that while stocks rallied, bonds actually fell, and which is odd. So what's going on there? There are a few possible things at play. One is just what's going on within the market itself, which is there potentially could be hedge funds selling off bonds as they wind down risk in some strategies. We don't really know. Another thing is the bond market, which is based on expectations of the future, trying to figure out what the Fed will do. So we just talked about what happens if, we don't know it's going to happen, but if inflation does go up and growth is subdued, if you have that tricky combination, what's the Fed going to do? So it's trying to process that. And the third one is that there may be less demand overseas for bonds at the moment. So there's this viewed as a kind of a risk because of the political uncertainty of this. Remember, these are countries looking and trying to figure out what's going to happen in 90 days. Is raising the tariffs on China a negotiating technique to get them to the table? Or is it something that will actually be followed through on with the idea that jobs will be brought back to the US? And the problem is, I think that people don't know really what's going on. And I think there's a bit of uncertainty in policy that's hurting the bond market. Just this afternoon, one of the Fed governors said that the Fed stood ready to intervene in the bond market should anything go awry there. But it has been an odd week in the bond market.
So wrap this up. Everybody's nervous, uncertainty, but at Edelman Financial Engines, what are we doing with clients? What do you recommend clients do?
Yeah, it's clearly an uncomfortable time, right? Without a doubt. I feel it, when I look at the news all the time to see what's driving markets. However, the advice about staying invested holds. We said, on a prior recording that if big up days can come in the midst of a series of big down days, and we saw remarkable up day on Wednesday, right? And the thing about trying to time these things is it's generally unpredictable, and I think it's especially unpredictable at the moment. You've got to get it right twice. You've got to figure out when to get out of the market. That's one decision. But you've also got to figure out when to get back in. And it's hard to get one of those right, never mind two. So the advice, I think, is uncomfortable as it can feel along the way, is to stay invested. And the second thing I'd note on that is diversification is doing its job. US equities are having the hardest time of all asset classes at the moment. And your portfolio will have some of those, but it's also got international stocks not doing as badly, and treasuries, even after this week, treasuries looking positive for the year. So, stay diversified. Stick to your plan and really focus on controlling what you can control. That remains the advice for people invested in the market.
Thanks, Neil.
Thank you.